Thank you so much. It is such an honor to be here at Google. Thank you so much for having me. Dippy, thank you for that wonderful, warm introduction. Great pleasure to be here. We're going to talk about student loans. We're going to delve into personal finance. We're not going to talk about the Lemonade Life today, my new book, but I have promised to come back early next year and we'll do a whole talk at Google on the Lemonade Life. So looking forward to that. Grab a copy when you can. So we're going to talk about student loans. Just quick survey of the room. How many folks have student loans today, would you say? Just raise your hands. Great. How many, well, not great, but congratulations. How many people have paid off student loans? Okay, even bigger congratulations. How many of you don't have student loans but want student loans? Not many people. Okay, so we're going to talk about student loans, but before we do that, I want to talk about a more pressing issue. This is a big issue that affects everybody in the room. And of course, I'm talking about 3 things to never do at a talk at Google. So that's really what we're going to talk about first. It even takes precedence over student loans. So the first thing you never want to do at a talk at Google is say that Alta Vista is your favorite search engine. Not a good idea. It's a great company, used to be a big powerhouse, but whenever you come to Google, don't mention Alta Vista as a great company for search. So for example, you don't want to say, I just Alta Vista'd that. Probably not a good idea. Similarly, if you have an answer, you need an answer to a question, don't say just Alta Vista it. So probably not a good idea. You know, I was thinking about this slide and what to do and just give you some background behind the scenes. I was saying, should I go with Alta Vista? People remember that company from 20 years ago. Also thought about Lycos. I was deciding between the two, didn't know which one to go with. So I actually Googled it. And looking at the search results, I went with Alta Vista. Significantly more search results than Lycos. So that's just a little behind the scenes for how that slide was created, if anyone was interested. Number 2, the second thing you don't want to do when you come to Google and give a talk, don't keep mentioning the word googliness, okay? Just because you saw the movie The Internship, fantastic movie by the way, don't keep bringing up the word googliness. It doesn't look great. And then the third thing that you don't want to do when you start giving a talk at Google is keep asking the question, is the food really free? It is. The answer is yes. So those are the 3 things you shouldn't do when you give a talk at Google. But with that, let's talk about student loan debt. That's why we're all here today. It's been a big issue in the media. It affects so many people here in the room and watching online. And it's become a hot topic issue also for the presidential race and for policy. So we're going to hit on 4 things today. We're going to talk about student loans, talk about an overview, go through some student loan debt statistics, and give you a lay of the land. We're then going to move into some proposed solutions that have come out in the forefront, some good, some not as good, and we'll get a chance to delve into those. Then we'll talk about some practical repayment strategies that all of you can take who have student loan debt, either here today or watching online, how to pay off your student loans faster. And then we'll definitely save some time for some Q&A. So just to get a lay of the land, there's about $1.6 trillion of student loan debt in this country, spread across 45 million borrowers. The average student loan debt's about $30,000. And if you look at the monthly payment, it's around $400 a month. So that's just to give you a set of how it looks today. Now, in terms of the landscape of all consumer debt, student loan debt is considered the second highest category at $1.6 trillion of all consumer debt. Mortgages is number 1, about $10 trillion for residential individual mortgages, so it's significantly larger. But if you look at some other consumer debt like credit card debt, auto debt, even personal loans, they hover around the $1 trillion mark. So just to understand the magnitude, student loans about several $100 million larger than the next followers of auto debt and credit card debt, but significantly lower than mortgage debt. So when you think about a student loan crisis in terms of magnitude, the other consumer debt is much less than mortgage debt. That said, there have been concerns, obviously, with people collecting a lot of debt at a young age, right? It inhibits ability to save for retirement or get a mortgage and buy a house, family formation, having a family or having a child, starting a business, and just overall starting out your life with a lot of debt. So that's been a lot of the issues that have been emerging with student loan debt. So why has there been so much student loan debt? Where have we seen this growth and why is it happening suddenly? So over the last couple decades, we've seen explosive growth, 5x increase in student loan debt. There's many drivers, but I'll highlight 4 for you. So more access to higher education. So what that means is the federal government and legislators and so forth have been promoting more access and opportunities to go to higher education. So the federal government, which is the largest lender of student loans, of all the $1.6 trillion, it's more than 90%. doesn't underwrite student loans, meaning it's not like a private lender that looks at your credit score or how much money you make and decides if you can get a student loan or what the interest rate will be. Everybody gets a student loan from the federal government. For the most part, the interest rate is the same regardless of your credit score. So you have a 500 credit score, an 800 credit score, everybody pays the same interest rate. It's a fixed interest rate. And so as more people go to college and go to graduate school and so forth, more student loans become available and outstanding. Tuition increases. We've seen significant increases at private colleges and even the public universities over the last couple of decades, as high as 200% in some private colleges. So that's been making people borrow more loans, not only federal student loans, but also private student loans. Thirdly is the state funding cuts. So there's been a movement over the past couple decades of federal funding for colleges and universities, particularly the public universities, and that's been dwindling. And so there's been a shift to the states, and the states have been responsible through tax dollars to essentially pay for public education. But what's been happening is there have been cuts as people have not wanted to see high taxes, income taxes in particular, property taxes. And so there's been a pullback in state funding. And that's caused, even here in California, you see schools, for example, to be a lot more expensive for students to attend, which has led to more borrowing. And then finally, the financial crisis of a decade ago, still some lingering effects, right? We've had family income not rise as fast as the cost of living, and a lot of people have not recovered from it. So they've been having to borrow more money and have lower savings amounts to pay for college. So those have been 4 drivers. There are others, but these are 4 that I think are worth highlighting to understand why we have so much student loan debt today. I want to go through some facts that are very interesting. A lot of people haven't thought about with respect to student loans. So the first thing I think it's important to know, we hear a lot about people borrowing $100,000 of debt or more, but that's actually a very small fragment of the outstanding student loan debt. So only about 6% of borrowers owe more than $100,000 in student loan debt. And many that do are graduate school students. And similarly, only 2% of borrowers owe more than $200,000. So if you look at the entire schematic, about 8% have more than $100,000 of student loan debt. So I think that's important to note. Similarly, 18%, almost 20%, a fifth of the 1.6 trillion is for people who have less than $5,000 of student loan debt. So when we think about a student loan crisis, it's not necessarily $100,000 or more of outstanding debt. It's a lot of people have less than $5,000, a much smaller amount. Graduate school debt, another reason why we've seen a lot of borrowing. About 50%, so about $800 billion, is due to graduate school debt. So about a quarter of all borrowers, 11 to 12 million, are borrowing graduate school debt. That tends to be repaid at a higher rate. People who go to graduate school, for the most part, for professional degrees, a lawyer, a business school, dental school, medical school, they have the income to pay back their loans, so we see a lower default rate. This is a big issue. About a quarter of all borrowers don't even have a bachelor's degree, meaning they didn't finish school, they had to drop out for one reason or another. They may have attended an associate's program. We've seen a growth of the last 20 years of for-profit education. These are schools outside the traditional Title IV programs of public universities and private colleges, where folks may not get a 4-year degree, they may get a 2-year degree, or they drop out, but they're still borrowing the debt. And unfortunately, even if you don't earn a degree, you have to pay it back, that debt. For the most part, if you have private student loans, there are ways to not pay back through the federal system, but people still are holding that debt. As I mentioned, borrowers who owe the most student loan debt are not the ones who default. It's actually the people who have the lowest amount of student loan debt, believe it or not. So it's not necessarily based on the amount that you owe. It's based on how much income you may make and other factors, not necessarily the amount of the student loan debt. Coming back to for-profit colleges. So when you look at default rates for the federal student loan portfolio, they're around 11%. That's the stated amount. And when we say default, we mean you haven't made a payment in at least 270 days, so 9 months without making a payment. In addition, there are delinquencies, so if you haven't paid your student loans for 90 days or more. Okay, so when you combine those two, it's much higher than 11%. Some people think that the federal rate for delinquencies is actually understated. There have been estimates that by the year 2023, you could see up to 40% of people defaulting on their student loans, which is hard to believe, but that may happen. Unfortunately, hopefully it won't. But for-profit institutions today, for-profit colleges, 40% of borrowers in a 2-year for-profit education program are defaulting, and 32% in a 4-year program within 5 years, which are pretty staggering numbers. The reason that's happening, many people think, is because of the opportunities, the gainful employment that a lot of these graduates or attendees face when they leave for-profit institutions. And that's been one of the critiques of that system, because they don't actually receive gainful employment. On a positive note, 30% of borrowers graduate with no student loan debt. And that's due to a variety of reasons. They may have gotten scholarships or grants or just had other resources to pay for school. So that's one of the positive things if you fall in that category. This is interesting too. So on a percentage basis, not on a dollar basis, but percentage basis, the largest growth in student loan debt has actually been with ages 60 to 69. So a lot of parents who have been borrowing to help their children or other dependents go to school. And you can imagine the situation that happens there. A lot of them are leaving the workforce, they're saving for retirement, but they're still borrowing debt. And so a lot of that debt comes from the federal government. It's called a Parent Plus loan. And Parent Plus loans are borrowed in addition to private student loans, and that creates obviously an issue for folks who are trying to retire. And that debt happens to be pretty expensive relative to usual federal loans. It's about 7% interest rate. So you can imagine it gets a little complicated for folks who are trying to retire. But that's been one of the largest growth. Again, not on a dollar basis, but on a percentage one. And then coming back to for-profit colleges, more than 50% owe more than $40,000 in student loan debt when they graduate, which is higher than the average of $30,000. So for-profit education, as you can see with both defaults and the borrowing amounts, have been difficult. This is pretty predictable, but the borrowers by age, just to show you, the largest contingency is the less than 30 years old, followed by 30 to 39, and then the 40 to 49 category. Again, the 60 to 69, largest percentage increase, but it's been the lowest amount who actually borrow student loans. In terms of how much is owed, in terms of categories, so the largest amount of debt that's owed is the $10,000 to $25,000 amount. Followed secondly by the $5,000 to $10,000 and $1,000 to $5,000, and then $25,000 to $50,000. So most student loan debt is under $50,000 that's owed, but that main category is $10,000 to $25,000. I'm just thinking of magnitude, and the larger amounts, as we talked about earlier, above $100,000 or $200,000, very small contingencies. So that's the general framework for student loans to give you some background on the lay of the land of how it exists today. But let's talk about some of the proposed solutions that have come out and how that could impact you if you have student loans or you're just interested in where the election can go and how policy and so forth can be implemented. So the biggest solution that's out there right now and one of the most popular is about student loan repayment. So these are federal loans and how you can best repay them. So right now there's so many different ways to repay federal student loans. They're quite frankly very confusing. So this is everything from an income-driven repayment plan where it's based on your income. We'll get into that in a little bit. And different ways that you can simplify that system. So rather than having multiple different types of standard repayment, graduated repayment, extended repayment, income-driven repayment, how can you simplify it and just make it one or two standard plans where it's a percentage of your income each month, and then you can get some student loan forgiveness on the backside. So that's been kind of the biggest focus of the education department, the president, presidential candidates, and so forth. We've also heard a lot about student loan forgiveness, really hot topic in the presidential election right now. Many different proposals for student loan forgiveness. There's one proposal that would forgive all $1.6 trillion of student loan debt. So if you have federal student loans or you have private student loans, if that proposal happened through legislation, all of it would go away. That's exciting for people who have student loans. It may not be exciting for people who just paid off their student loans like last week. What happens there, right? That's been a question too. Is there some kind of retroactive reimbursement or tax credit that you get? Also, what if you borrow loans, next week? What happens then? Like, do you get forgiveness? That's been a challenge as well. Other programs or proposals would forgive a proportion of debt based on income, for example. Some have tax credits to people who paid off before. A lot of different proposals floating around right now about student loan forgiveness. For the federal government, it'd be simple, it'd be a write-off, but for people who have private student loans, presumably the federal government would write a check to private lenders or investors who hold that student loan debt to make them whole. So there are some issues with that, and also how it gets paid for. Is it through a new tax? And who ends up paying for that tax is another important issue. There's been a more controversial proposal, which is make colleges accountable, right? I mean, colleges are the ones who are charging the tuition. If a borrower defaults on a student loan, should the college be responsible? That's something that's been brought up right now. Colleges obviously are not so happy about that, but that's something that could be proposed and considered. Another proposal is potentially limiting the amount that colleges can raise their tuition, whether that can be done through federal law or not. But that's been one of the proposals about how to make colleges more involved in the student loan discussion. Another controversial topic is income share agreements, or ISAs. And as the name suggests, these are proposals where if you're a student at a college or a graduate school, you might come in and say, okay, you don't have to borrow student loan debt day one. You can go to the college, go to the graduate school, and then afterwards, you're going to give a percentage of your income to a group of investors who funded your college. So some people think that's great. They're really excited. They get to go to school, not worry about debt. And then they'll give, if they make a lot, they'll give a percentage. If they don't make a lot, then it'll be less. And other people are like, why would I give money? Where's my upside, right? Why am I giving away my money to a group of investors? So some people are very supportive of ISAs as an alternative to the student loan debt system we have today. And other people think it's very similar to a loan. They're just not calling it a loan today because you're still owing a portion paid back on the back end. In some cases, you may be paying more. Free college. Great headline, right? Who doesn't want free college? So there have been some various proposals about tuition-free college, right? It doesn't pay for everything, but it would be for tuition-free. This wouldn't really exist for private colleges and universities. It's more for the public system. So a lot of candidates running for president now have supported free two-year community colleges. Others have said we would support free public colleges, like UC schools, for example, here in California. And that proposal would essentially be the federal government somehow through subsidies or reimbursement to the states, because the state colleges are funded by state governments and tax dollars. So there'd have to be some sharing of financial responsibility between the states and the federal government. So free college has been a popular term as well. A not so popular term has been the automatic paycheck deduction, which sounds scary to many people, which was proposed by a senator that in order to collect more student loan payments, to withdraw it from your monthly paycheck or your bi-monthly paycheck. Not popular, right? I don't think folks want to see, income, healthcare, parking or driving, commuting, and student loan payment. So that has not been a very popular one, but something that has been proposed so the federal government can collect student loans more easily. Another plan that came out actually last week from another senator, which a lot of people have been up in arms about, is taking money from your 401k or your IRA, your retirement account, to pay for your student loans. So about $5,000 a year, and have some tax benefits and advantages to that. So that's kind of one side. Could you find another source of income? The flip side of that, of course, is, well, it's my retirement. Why am I spending my student loan payments from my retirement when I should be saving up rather than using it for student loan payments? So there's been a debate about that over the last week and more to come, looking at alternative sources. And then finally, employer contributions. So there's been a trend still in the single percentage digits of companies who have been paying for student loans for their employees. This is like an employee benefit. So you might see a percentage of your paycheck, or you might see a certain dollar amount that comes out each year. Various companies have taken the lead on this to help. And so that's been a boon to the federal government, because when you're seeing corporate America step up, whether it's a large business or a smaller one, to help their employees with student loan debt, that takes the heat off the federal government, so to speak, to help them pay for student loans for employees. So these are again the issues of student loan solutions, student loan repayment, student loan forgiveness, make colleges accountable, income share agreements, free college, automatic paycheck deductions, pay with your 401k, and then employer contributions. There are others, but this is worth highlighting. So with that, let's jump into repayment strategies. I know some of you here and watching at home or at work have student loan debt. And look, you guys are the smartest people in the world. You work here at Google. You were able to get hired. You've been superstars. And yet I meet so many smart people who just don't know exactly how to pay off their student loans. And it's nothing to be shy about. It's a very complex system. It can be confusing. And what happens for one person may be different than what happens for another, because your financial situation is unique, your goals are unique, and it's not a one size fits all. So you really need to find the right strategy for you that makes sense and optimizes your financial outlook and your goals. So the best way to think about student loan repayment is to think about these 4 pillars, okay? So the 4 pillars for student loan repayment are these: student loan refinancing, student loan consolidation, income-driven repayment, and student loan forgiveness. So this is the way I think that everyone should approach student loan repayment. Okay, and I'm gonna delve into each one of these, and then we'll definitely save time at the end to talk about questions that you have regarding your situation or just something you're curious about. Student loan refinancing, definitely the most popular approach that many take to pay off their student loans. So student loan refinancing is the process of taking your student loans, your federal student loans, your private student loans, or both. You combine them all together and you exchange them for a new student loan, okay? And that new student loan has a lower interest rate. When you get a lower interest rate, obviously you can save money each month, and that's kind of the goal of repaying off your student loans faster. The benefits of student loan repayment are you get to, number one, combine all your student loans into one. So you're not making multiple payments every month. You're not dealing with multiple lenders. It's just one interest rate. It's one monthly payment and one student loan servicer. So the student loan servicer is the entity with it you communicate each week or each month whenever you have questions and where you send your payment. Student loan refinancing is also very flexible. So not only do you get a lower interest rate, but you can choose whether you get a fixed rate or a variable rate. Remember I told you that federal student loans, you can only get a fixed rate. So depending on your preference, you can get a variable rate or a fixed rate. Variable rates are lower than fixed rates. So if you're looking for that lower rate to pay off faster, the downside obviously is variable rates can change with the movements in interest rates. The Federal Reserve has cut interest rates significantly this year. So student loan refinancing rates are actually less than 2% right now for variable rates. So if you're paying more than 2%, which most people are, definitely an option to look into. You can also decide how long, what duration you want to repay your student loan. So for example, the standard repayment term is typically 10 years, right? That's a federal student loan standard repayment term. But with student loan refinancing, you can choose anywhere from 5 to 20 years. So you would choose 5 years, you would have a higher monthly payment. So even though you have a lower interest rate, you're paying more because you're paying off it for 5 years, but you'd save tremendously in interest. Likewise, if you need more time each month and you want to pay lower each month, but you want more time, you can choose closer to a 20-year repayment, lower monthly payment, lower interest rate, but you'd pay more in interest over time. So you have that flexibility to decide. There's no federal student loan refinancing, so you can't refinance your loans with the government. So you actually would do it with a private lender. There are a host of top-notch, reliable, trustworthy partners. We have many at my company, Make Lemonade, but you can choose one that works for you. And these are anywhere from fintech companies to banks, other financial institutions who will refinance your loans. The process is really simple. It takes about 10 minutes, 15 minutes online to complete the application. You can check your interest rate for free in about 2 minutes just by online. And essentially, if you like the rate, you can go with it and apply. If you don't, you can find a lender that works for you. You can apply to multiple lenders at once. There's no application fee, no origination fee, and no prepayment penalty. So you can pay off your student loans anytime. And then a question I get a lot is, well, how often can you do this? Are you only limited to one time? And the answer is no. You can refinance as often as you like. So whenever you get a lower interest rate, it's just a matter of taking the time to do the application. You're not charged each time you do it. You can go with a different lender each time, whatever works best for you. So that's student loan refinancing. There are some scenarios where you don't want to refinance your student loans. For example, and we'll get to it in a second, if you want to keep your federal student loans outstanding, if you're looking for an income-driven repayment plan, for example, meaning you want a lower payment each month and you can't afford your payments, then you definitely want to keep your federal student loans outstanding. Also, if you're going to do student loan forgiveness through the public service program, which I'll talk about, or if you're looking for other protections like forbearance or deferral, which allow you to pause your payments and defer some of those payments if you can't afford them each month. So those are some considerations if you're deciding whether to do student loan refinancing or not, but it is the only way to lower your interest rate if that's your goal. Student loan consolidation. This gets talked about a lot and it gets confused quite frequently with student loan refinancing. So student loan refinancing is you are consolidating your loans, meaning you're combining them together, but you are getting a lower interest rate with student loan refinancing. With student loan consolidation, you don't get a lower interest rate. So it's only with your federal student loans, and essentially you're taking all your federal direct student loans, you're combining them into a single student loan called a direct consolidation loan. And then that is equal to, the interest rate is a weighted average of your current outstanding debt, okay? So again, it'll simplify your payment, it'll organize your payment, you'll have one student loan servicer, one monthly payment, one interest rate, but it doesn't lower your interest rate. So if your goal is to do that, then you definitely want to refinance. But if you want to keep your federal student loans outstanding, direct consolidation is an example. And it's a weighted average interest rate, and it's actually rounded up to the nearest 1/8%. So it could be slightly higher, something to keep in mind. Income-driven repayment. So there are 4 types of income-driven repayment plans. These are for federal student loans only. And essentially, if you're looking to have a lower monthly payment because you can't afford your payments or you want to take some more time, income-driven repayment would be an option. So there's 4 types. There's income-based repayment. Again, this goes to the complexity of kind of the repayment plans I talked about earlier, but there are a lot of rules, a lot of names, but I'll just walk through them just so you get a general concept. Income-based repayment is called IBR. That's the acronym for it. Pay-as-you-earn, which is payee. Revised pay-as-you-earn, which basically revises the payee plan. And then ICR, income contingent repayment. So lots of fancy names, but essentially what these plans do is they take your discretionary income, which is the money you have left over at the end of a month, and they take a percentage of that discretionary income and that becomes your student loan payment. So they kind of disregard what your interest rate is, and they just base on how much you earn each month, and then that goes off to pay off your federal student loans. Now, the downside with this is, although you're making a lower monthly payment, which could be as low as 0%, by the way, based on your income, family size, and your state of residency, which is how they decide this, interest is still accruing on your student loan. So even though you're paying maybe 0%, maybe 10% each month, the balance is still growing over time. So that's something that's important for people to think about as they're considering income-driven repayment plans. Most of them, as you'll see, have between a 10 and 15% of discretionary income each month. And then on the back side, you can receive student loan forgiveness of your federal student loans after 20 or 25 years, depending on the plan. So IBR, for example, it's 10 to 15% of your discretionary income. The reason for that delta is because whenever you borrow the student loan, there's some cutoffs, whether it's 10 or 15%. And then you can get student loan forgiveness after 20 or 25 years. Now, the important asterisk with that student loan forgiveness, which they don't really tell you if you're not focusing on the rules, is that you unfortunately would owe income tax potentially on the amount that's forgiven. So if you can imagine for 20 or 25 years, you're making your monthly payments, you're doing your job, and at the end you have some balance that gets forgiven, but then you also could be liable for income tax payment on that amount forgiven. Okay, so obviously check with your financial advisor or accountant, or if you do it yourself, but just be aware of that there is that income tax component for all the income-driven repayment plans. Payee, it lowers it to 10% of discretionary income, and you can get student loan forgiveness after 20 years. Revised pay-as-you-earn or repayee, it's 10% of your discretionary income, but it actually separates it based on an undergraduate student loan or a graduate student loan. So 20 years for an undergrad loan, 25 years for a graduate loan. ICR is very complicated. It's not as straightforward as the others. It's really not as popular as the first three. So if you have just regular federal student loans, you should really focus on those first three. Parent plus loans, if you're a parent, this is the only way you can get student loan forgiveness for parent plus loans through an income-driven repayment plan. So the first three you wouldn't qualify for, which is ICR would be your option here, or to do the student loan forgiveness program through public service, which I'll get to in a second. And this forgiveness is after 25 years, and it's also 20% of discretionary income, and there's a formula, or you could pay less than that based on a different formula, which is here. So the final area is student loan forgiveness, and this is public service loan forgiveness. What happens here, this is a program that was created in 2007 by then President George W. Bush. And effectively, it's for public servants who work at a nonprofit or through the government, and they're working full-time, so at least 30 hours a week. And if they spend 10 years basically in public service, they make monthly payments for 10 years or 120 payments, they can receive student loan forgiveness on the back end. This student loan forgiveness is for federal student loans only. And the good part is it is not taxed. So this is the only program that will forgive your student loans in whole if you have federal student loans, and there's no taxation at the end. There have been a lot of headlines that have been out there. 99% of people actually who have applied for this so far have been rejected, unfortunately. The reason for that are manyfold. It's anywhere from incomplete applications to not understanding the process, not understanding the requirements. As this program, again, it was 10 years, so it started in 2007, so in 2017, people started finally getting forgiveness. I think as the program evolves and there's more transparency and people understand the rules, we'll see higher approval rates, but that's just something to think about if you are going to work in public service. There are other requirements, too, that are important. For example, you have to make a majority of your payments while you're on an income-driven repayment plan, so you actually have to enroll in that. If you have FFEL loans, which were loans that were done before 2010, you do need to consolidate those into a direct consolidation loan because they're actually not federal student loans. So there's a whole bunch of requirements. You also want to fill out a employer certification form each year and submit that to the Department of Education. So make sure you follow all the requirements because they are pretty rigorous to do. But if you can do it, you could have that as an option. Who do you contact if you have problems with your student loans? A lot of people say that their student loan servicer is not being great, they're not helping out, they're giving wrong information. Same with their lender. These are just some resources you can reach out to. Definitely contact your lender if there's an issue. Your student loan servicer, if you've had problems, you can report them. Try to have a discussion with them first. You can put all your correspondence in writing is a smart way to do it. Consumer Financial Protection Bureau is a federal government agency. You can report issues with consumer debt, student loans, or other types of student loan or non-student loan debt. U.S. Department of Education, the FTC, the Federal Trade Commission, if you've dealt with a company which you think is not doing right or not having fair practices, you can reach out to the FTC. And then your state attorney general. Many of the attorneys general have filed suits against student loan servicers recently, and are very keen on this issue of having fair practices and fair business behavior. So these are some of the resources you can reach out to. I just want to talk about quickly just some classic debt repayment strategies. You may have heard of these before. If you haven't, I'll walk you through them. So the debt avalanche and the snowball strategy. So debt avalanche is really the financial minds in the room and watching at home. And the snowball approach is the more psychological one. So the debt avalanche method says every single month, take all your student loans, make the minimum payment. And then if you have extra resources where you want to pay off your student loans faster, you basically rank order all of your student loans by interest rate. So from the most expensive to the least expensive. And you start applying any extra money that you have towards that highest interest rate first, because that's the most expensive. You pay all that off, and then each month you keep repeating this. Pay the minimum payment, take extra resources, and pay off the highest one. Keep rank ordering, and that'll save you the most amount of money and allow you to pay off your student loans faster. The snowball method, for folks who like those small psychological wins, disregard the interest rate and focus on the balance instead. So you look at your smallest balance, and then your next, going larger, and then pay off the smallest balance with any extra money you have after paying off the minimum payment. So if you have that $1,800 loan, that's your lowest loan that you have, pay off that balance, feel good about yourself, move on to the next one, and have those small wins. So these are just two ways to think about student loans. I'm going to skip to just some final advice before we open it up for Q&A. Don't rely on your student loan servicer for advice. I know that sounds crazy because a lot of you call your student loan servicer and you're like, what should I do? Look at my loans. I can't make my payment. What's the best advice you have? The best advice I have for you is to do your own homework, okay? Student loan servicers can be great. Some of them are wonderful. Some of them are not as wonderful. But I would really implore all of you to do your own homework. There was a recent litigation in some court documents where one of the student loan servicers essentially said that they don't have a fiduciary duty to necessarily give people advice. They're just there as a resource for customer service. So I would really, for all the people who've been frustrated, put your correspondence in writing. That's another thing too. There's a lot of people who come up to me and said, I told my student loan servicer to do this and they did that instead. So one way to prevent that is to keep a document trail. Know the rules. Every repayment plan has rules, and they can be complex, unfortunately. The Public Service Loan Forgiveness Program is one. Income-driven repayment is another. If you're going to enroll in one of these plans, just make sure you understand the ins and outs. We've talked a lot about them today, but there's other resources you can go to at Make Lemonade, for example, or other places through the Department of Education that can give you kind of line by line what you need to do. And if you're not sure, definitely reach out to other folks who can help you understand the best way to approach it. Student loan calculators are tremendous. I would recommend that everyone looks at them. There are student loan refinancing calculators. If you want to refinance your student loans, there's figuring out your weighted average interest rate. How does income-driven repayment work? It can show you what your monthly payment would be and how much student loan forgiveness you can get. Definitely take an approach and some time to do that. If you want a lower interest rate and you're not qualifying for one today, definitely work on improving your credit score. A lot of the companies either look at credit score directly who are doing student loan refinancing, for example, or the underlying components. So they're looking at, do you have a history of financial responsibility? Are you paying all your payments on time? Have you skipped any payments? Another big thing is debt to income ratio. So student loan refinancing, for example, will look at what's your income? Do you have stable recurring monthly income? So they want to see people who are making money, consistently on a paycheck. Typically people who are consultants or unemployed or they don't have a regular paycheck are less likely to get approved for student loan refinancing. You can definitely apply with a cosigner who meets all of the requirements, but that's something to think about. Definitely focus on your credit score. So, as I said, no missed payments, no late payments. Look at your credit utilization as another term also. So if you have a credit card, for example, and you have, let's say, a $10,000 limit on your credit card, and you spend $1,000 a month, that would be 1,000 out of 10,000, that's 10%. So the lower credit utilization you can have, the better, because it shows you have a lot of credit to borrow. It means you're credit worthy, you're financially responsible, and lenders look at that in a positive light. So focus on your credit score if you want a lower interest rate. And finally, student loan forgiveness is not free. There are a lot of companies that have been out there that have been scamming people. I would just put that out there. There used to be, during the Obama administration, it would say, Obama student loan forgiveness, click here. And you just want to be careful about that. And just to be very clear, no private company can give student loan forgiveness. It doesn't exist. the only federal student loan forgiveness program. The main one is the Public Service Loan Forgiveness Program. There's also Teacher Student Loan Forgiveness Program. There might be some state programs that exist, but don't fall for a company that wants to forgive your student loans because it can't happen. And again, it's only for federal student loans. Private student loans, you're basically entering into a contract with a private lender. Those are wonderful too. Just make sure you read the fine print and you understand what protections you have or don't have. And with that, let's open it up to questions. If you have any on any of the topics we've talked about today, either your personal student loan situation or policy topics, would be happy to answer anything that you have.
One, what exactly happens when you default on the student debt? Another one is, in your presentation you mentioned that the tuition increased, but also the student loan amount increased. So I wonder if there's causation there. If the tuition increased because there is more student loan and more money to pay for the tuition. And the biggest question is, you mentioned that the corporate world started to help with the student loan, but I wonder, isn't it the same as the automatic paycheck deduction?
All great questions. Thank you very much for those. So let me answer all of those. So yes, there are ways to rehabilitate if you have defaulted on your student loan. So through the federal system, again, if you have a federal student loan, there is a process you can go through to make yourself whole and to get back on track. So there is a way to rehabilitate. You will have a detriment or decrease in your credit score if you do default on your student loans. But the federal government has laid out a plan for you to have that rehabilitation. So there is a way to get back on track. With a private student loan, you actually have to speak to your private lender. Some private lenders allow you, if you're getting into financial trouble or you think you can't make your payments, the best advice I have is to start that conversation, right? Don't wait till the 10th month and just be like, oh, wow, I just defaulted. If you think you're in trouble and you can't afford it, definitely reach out to either the federal government, your student loan servicer, or to your private lender and talk to them about options. A lot of private lenders, for example, allow you to pause your payments. Interest might accrue still, but they may allow you to pause your payments for up to 12 months, even longer with other folks. The other question you had was about some of the corporate, the companies that are helping to repay. It's actually different. So what the companies that are helping to repay, what they're doing is they are actually taking money from the company and paying off your student loans, right? The paycheck deduction that was talked about was a proposal from a U.S. senator for a federal student loan to be repaid to the federal government from the student borrower, right, from the borrower itself. So one is a company paying off your student loans or helping to pay off your student loans. The other is your federal student loan payment being taken out of your paycheck, right?
It's just mental accounting.
Yeah. Well, it's a little bit different, right? It's a little bit different. One is you're paying for it and one is your employer is paying for it, right? So yes, it still pays off the loan, but it really, where does the source of income come from? And then your other question, whether it's causation or correlation regarding tuition increases, you probably have to ask the colleges and universities. But over time, look, a lot of research grants and money comes from the federal government and other sources to help universities and colleges grow. At the same time, there has been a increase in the amount of federal student loan debt that's available. So you probably have to ask some of the colleges what's going on there and how they set tuition. Please.
Zach, thanks for being here.
Thank you for having
some
me.
really insightful stats in the presentation, and always good to know I'm not alone in this get out of debt journey.
Nobody's alone here.
My question is, for those of us who've been fortunate enough to have our parents contribute to the cost of our education, who have taken on debt, what are the tax implications as we start to think about reimbursing our parents for some of those loans they may have taken out on our behalf?
Tax implications for you in particular, or just?
Yeah, let's say sending my parents.
Yeah, so look, there's a student loan interest deduction each year up to $2,500 that can be taken for borrowers in general. But if your parents paid off your student loans and you're just going to reimburse them because you have a agreement between you and your parents, there's probably not a tax issue that comes there that you have in terms of a deduction or something. You probably have to speak with an accountant on that. But typically, if someone else is paying for your student loans and you reimburse them privately, that's typically not a tax advantage way to do it unless you've spoken with an accountant or a professional on that.
Hey, Zach.
Hey, how are you?
Good. Thanks for being here as well. I was wondering if you could speak more to holding colleges accountable and the relationship with federal loans being guaranteed, because I feel like maybe it's a bit of personal opinion, but that definitely contributed a lot, as you spoke about, to the rising costs. And I'm curious, like with all of these policy discussions with the election and all that, what do you think are some of the most promising outcomes if you either changed how we give out these loans and guarantee them, or if colleges were actually held accountable to the success and kind of earnings down the road? Like, are there, I guess, how does that work out? Are there any ways that you could elaborate on that, turning out in reality after, some policy changes?
It's a great question. So as of today, colleges are effectively not responsible, right? So if they have folks who go to their college, whether they graduate and become very successful, or they graduate and don't become successful, or they don't graduate, colleges and universities are not held responsible. So student loans are issued by the government. They're used to effectively pay the tuition. And if you default, it's really on the borrower because their credit score gets hurt. And if it's a federal student loan, it's on the federal government, right, who kind of loses and through tax dollars effectively. So there haven't been any formal legislation or proposals that have caused that. If it were to happen hypothetically, it'd be a very interesting question, right? I mean, would colleges change the way that they admit people, or but which creates other implications, of course, because they can't base it on someone's income. I will say a lot of schools and colleges have stepped up. I wrote a Forbes column about this. There's at least 75 colleges or more that are paying either a good portion of scholarships and grants to make college tuition free, or certainly subsidizing a great deal. That tends to be income based for the non-merit based financial aid. So there have been a lot of colleges that, although you see this kind of headline tuition rate, the net price that's paid is a lot lower. But there haven't been colleges that have been held accountable. But it would be interesting if it could even be done, right? Because could a federal legislation regulate a private college? Maybe public colleges could be different, but it would definitely be an interesting question. But there hasn't been any implications today. I think there's some things that could happen. Again, a lot of wild cards. One issue that's coming up is bankruptcy in student loans. So currently, for the most part, you cannot discharge student loans in bankruptcy, which has been a big issue. There are exceptions, as there are to every rule. It depends on which circuit court you're in, but there are different financial tests that are applied, and people have been able to discharge despite the rule. But that could change. That's one of the things that's been talked about, bipartisan. There also may be some simplification of student loan repayment plans, so they're a lot less confusing and so many choices, just to make it literally one plan or a few plans that are clear. And there have been other proposals as well, but those are some of them that could have some legs.
What about not having student debt to start with? Can you talk about strategies around scholarships?
Absolutely. So if you're going to pay for school, the order that you want to approach it is scholarships number one, grants number two, federal student loans number three, private student loans number four. Scholarships and grants obviously are great. You don't have to repay them at all. So I think starting early is probably the best way to approach it. There are thousands of scholarships from general merit-based scholarships, just putting the financial aid ones aside for a second. And there's very specific ones too, based on a variety of factors. So I think starting with different scholarship search engines are a great place to start. To find scholarships. But yeah, there are ways to pay for a lot of your school through scholarships. Yes, they are competitive and may have requirements, but there also may be specific scholarships at the school as well that can be quite generous. And then there might be scholarships you can apply while you're at school as well. But I think starting with search engines and reaching out to your financial aid office at your college or graduate school are a great approach to do that. But definitely max out your scholarships and grants as best as possible. Then federal student loans you'd want to max out next, and then private student loans. I will say private student loans right now actually have lower interest rates if you can qualify for them than federal loans in some cases. But still, federal student loans have a lot more borrower protections than private student loans.
I actually have a question too.
Yes,
How
please.
do you see the correlation between larger companies hiring with people who have degrees versus, do you feel like that's kind of like burdensome for young people to see these larger companies only accepting folks that have degrees? I feel like that puts a pressure to attend college and accrue that debt anyway. Do you feel like it's like this vicious cycle?
Yeah, I mean, look, there have been a number of companies, including this one, that have been hiring folks who don't have a degree necessarily, right? And I think whether we'll see more of that, right, based on skills. If you're a programmer, for example, right, if you had some kind of alternative education, yes, it puts pressure on individuals who have student loan debt and companies that are hiring people with degrees. But I think there is a movement, a small one, where folks are being hired without a degree who may not have student loan debt, and I think that could change the game a little bit.
Of that.
Yeah, exactly. Experience and skill set in lieu of that. I think for the most part, your traditional kind of path is people have a college degree and they have student loan debt, with the exception of that 30% I mentioned earlier who don't. But yeah, it's a really good point that you raise.
Yeah, interesting.
Hi there. So I work on search, and I'm wondering how people find resources at different stages of their journey. And are there resources they look for, and how successful are they at finding them?
Yeah, there's some wonderful resources. My company, I'm the CEO of Make Lemonade. We have a ton of resources on student loans and other types of consumer debt to help people kind of give very objective advice on ways to repay student loans, borrow student loans, refinance, and so forth. There is a lot of information out there, and I think people should start definitely when they borrow student loans, when they're thinking about either college or graduate school. That borrowing process is really the best time to understand what you're getting into. In some cases, if you want to go to college and this is the cost, and you've gone through all your scholarships, like this is the amount you have to pay. But really understanding what it means, right? If you're going to major in something or go to a certain school and you want to have a certain profession, you should understand what the income is going to look like on the backside. A lot of people don't do that. I think, myself included, when I went to college, you just kind of signed the dotted line and that was it, right? I think to the extent you can think about holistically, if you know at a young age what you're going to go into and how much you can earn, I think that's important. I think while you're in school, it's important to understand what your options are going to look like once you graduate, right? Like what kind of repayment plans you want to look at. Do you want to refinance your student loans? What are the requirements to do that? Are you going to work in public service? I think having a game plan early on is really going to help a lot of people. And then when you graduate, it's important when you start qualifying to refinance your student loans, for example, is understanding the choices you need to make. Does it make sense for you? How do you lower your interest rate? How much it'll help you? And I think having a game plan of how you're going to repay, and definitely sign up for auto pay. That's important, so it's automatically being deducted. But also, if you want to pay off your loans earlier, there's no prepayment penalty, right? I know everyone might not have the resources to make extra payments, but just because you get a statement every month that says this is the payment owed, like that's what the lender wants you to pay, right? You can pay a lot more than that if you want. So you can prepay student loans whenever you want, and there's no penalty. It's not like a mortgage where you have a prepayment penalty clause. So if you can pay off student loans faster, like definitely be proactive about that, right? Have a game plan of how you're going to do it. Don't just figure out what your friend's doing or what your cousin's doing. You should do what's best for you. So I think along that whole trajectory, you should have a repayment plan. It's important.
I find it interesting that when we talk about like the employer contribution, like we're saying that like, oh, it's great, it's generous that these employers have that as part of their compensation package. But I'm thinking back to like growing up, I heard stories about like my uncles and several of like, my friends' parents were just like, yeah, I went to work and one day they just tapped me on the shoulder and just like, oh, do you want to go get your MBA? We'll pay for it. And you just work for us for like 2 years afterwards. And then it's completely like free to you. Mm-hmm. So I'm wondering like why that type of employment like has completely declined, because you don't hear about that anymore. I have my own like thoughts around that, but I figure, yours are probably much better thought out than mine. So
it's a good point. You're right. I mean, back in the day, you'd hear in different industries, your employer is going to pay for you to get an MBA, and that happened frequently. It happens less so today. You're right. It's not happening as much. There's still great companies that offer benefits for people to go back to school. It may not be for an entire degree, but certainly a lot of it can be subsidized. Why that's changed, it's hard to say. I think the amounts may have gone down, but I think the approach here with the employment contribution is to make it more democratic and wide scale. Not everyone may be going back for an advanced degree, right? I mean, people have student loan debt, and so they're different, right? One's like an educational benefit that someone wants to get to further their educational degree or finish their college degree. Like Walmart, for example, has set up a program for all of its associates to earn a college degree. They have set up a program and they're effectively subsidizing it. Other companies have done similar things. So I think this is a chance to get people who have student loan debt. It's definitely been a wellness benefit, I should say, to attract people, especially young people, to companies. So that's what I would say on that. But it's a really interesting point that you raised.
In your opinion, or in your observation, what are ways that technology has assisted folks in going through that complex decision process? Have you heard of companies like Savvy that apparently give employers automated platforms to help their employees basically pay off their student loans and advise them through the process? And then really quick follow-up question, what do you think of the policy proposals that you put up on the screen will be center stage for the 2020 presidential election next year?
So yes, technology has played a huge role. I think technology has definitely made things more transparent, right? Like student loan calculators, for example, apps and platforms that have helped people repay off their student loans, manage their student loans, put them all on one screen, for example, I think has helped people a lot more, showing different ways of scenarios of what it might look like if you choose one plan versus another plan, right? I think all that builds transparency and having people understand the rules and just doing it in a much faster and more efficient way. So I think technology's had a huge part in helping with repayment, for example. It's a great question. So with that, thank you so much for having me. It's an honor to be here at Google, and we'll see you next time. We'll talk about the Lemonade Life. Thank you so much.